In this video, I'm introducing another control account of sales revenue, which is a sales return and allowance. We know sales return and allowance for most sellers, either online or in-store sellers, most of their products, except fruit and vegetables, milk, okay, most products are allowed to return to protect the customer. So the return will potentially decrease the revenue. So sales return is a control account of sales revenue. Allowance basically is the price matching, okay, which also will decrease the sales revenue. And for reporting, some firms combine sales return and allowance as a control account of sales revenue. Okay, so now we have two control accounts of sales. One is cash discount. The other is return and allowance. Okay, so they are all control accounts of sales revenue. So in the income statement, if the firm report their gross sales, you will always see these two. And the difference is net sales. When we recognize credit sale, we recognize revenue, we also recognize accounts receivables. And accounts receivable will also be affected by returns and allowance, especially before the customer make the payment, they return the products, right? In the balance sheet, so the control accounts of accounts receivable is allowance for sales return and allowance. And because there is a potential some products will be returned, and the price matching is also very popular. Both will decrease the sales revenue and accounts receivable. So that's why we create these two control accounts. In this example, Max Glass sells $5,000 of hurricane glasses to Oliver Builders on account. So on account means it is credit sale. So Max Glass recognize accounts receivable, the gross amount $5,000, and the recognized revenue, which is also gross amount $5,000. As I said, return and allowance are part of the sales contract. So that's customer's right, okay? So there's always a percentage of sales will be returned. So for each firm, they should estimate how much will be returned or how much allowance will be granted. So in this example, Max Glass estimate $400 will be either returned or as a price matching, which will reduce the sales revenue or accounts receivable. So Max is going to recognize first sales return and allowance, which is a control account of sales revenue. So it's contra revenue, so which will decrease the revenue. And also credit allowance for sales return and allowance, which is a control account of receivables, right? Because the customer return $400 or you grant the customer $400 allowance, the receivable will decrease. But keep in mind, this is just estimate. This is not real event. Okay, in accounting, this is a very popular accounting treatment. So this is also actually represents the spirit of current accounting. It's conservatism. Okay, so before the return and allowance happen, we recognize them, which will decrease the revenue and the balance of assets, accounts receivables. So this is to prevent the firms to overstate their revenue and asset. The reason is because this is allowed, right? For example, Walmart, right? Walmart has millions of sales every day, but it also has thousands of return, and maybe price matching, which will decrease revenues and the balance of the receivables. So because this is regular and persistent items, so before it happens, we should recognize it. The next one is if Max Glass grant an allowance $400 to the olive builder, which is the buyer. So this is a real transaction or event, right? So what we do is we write off accounts receivables, $400, and also debit the control accounts of accounts receivables. This journal entry does not affect the balance of assets. Why? Because the accounts receivable is a gross amount. It will less allowance for sales return and allowances to get net accounts receivable. And this journal entry, the credit accounts receivable will decrease $400 accounts receivable, and debit allowance for sales return and allowance will also decrease this $400. So the net accounts receivable does not change.